Welcome to FuturesOptionsETC.com's online options trading tutorials. You can also visit us on our website www.FuturesOptionsETC.com, or for any special training needs you can contact us at training@FuturesOptionsETC.com for a dedicated trading tutorial session. You can also visit us on our website, that's http://FuturesOptionsETC.com, where you'll find a lot of articles explaining the true payoff functions, detailed examples and graphs on how to trade options using different option strategies. There's also a search feature available on this website which you can use to search for your desired option strategy and browse through the results. In this trading tutorial, we'll see the long straddle trading strategy for options trading. Long straddle trading strategy comes from the scenario where one expects a big price movement in the underlying stock price or the index price, but the direction of that movement is not clear. For example, let's say IBM stock is currently trading at $50 per share, and you believe that IBM stock price will either rise to $80, which is a big move, or even higher, or it might fall down to $20 or even lower in the next 2 months time. So price move is expected, but direction, whether it will be up or down, the direction is unknown. So this makes an ideal case for trading long straddle. You can also trade long strangles on this, but that is a different topic and will be covered in another video. Here we are going to focus on long straddle only. So what do you do when you have to trade a long straddle? Basically, you take a combination of two long options. One is a call and other is a put. They are on the same underlying, that's IBM in this case, for example, and they come with the same strike price of $50 in this case. Assume that the call option is available for $5 and the put option is also available for $5. So the total price that you need to pay for this particular long straddle position is $5 plus $5, that's equal to $10. Now what will happen in case your prediction comes true? So assume that the price has moved upwards into the range of $80. So in that case, what will happen is you can exercise your long call option. This put option will expire worthless, so you will not get anything out of it, but from this long call option you can make $30, that's 80 minus 50, which was the strike price, and you've paid $10 for this, so therefore your profit comes down to as a net value at $20. In terms of percentage, the profit is 200% because you invested $10 in total of this and this premium, and you got 20 on top of it, so 200%. On the lower side, let's say your prediction comes true and IBM stock price actually goes down to $20. Again, the calculation will be that this particular call option will expire worthless, you will not get anything out of it, but this put option can be exercised and will give you $30, 50 minus 20, and you've paid $10 in total for the option premium, so your net profit will be $20. So the percentage profit will again be 200%. The typical scenario when one can go for this particular long straddle option trading strategy is when you expect a big price moves. Let's say a company is bidding for a particular project, and if it manages to get that particular project, then it might result in a big price movement. Other scenario is when the companies are expected to declare quarterly earnings or results, and then a big price movement is expected depending upon the result of that announcement. So accordingly you can take the long straddle option trading strategy. Only thing to notice, you need to keep in mind that markets are efficient and these option premiums might as well reflect that particular price movement already incorporated in these option premiums. So this was the profit scenario where we talked about. How about the loss? Say on the loss side, suppose your prediction is incorrect and IBM stock does not move much, it remains between $45 and $55, somewhere say around 50, then what will happen is you will lose the entire option premium that you took for creating this trading strategy. So this loss of $10 would be 100% loss. However, you are looking for unlimited profit potential with this limited loss. Of course, that loss will be 100%. So let's see how the payoff function for this would look like. Since we are buying two options, one is a call, other one is a put, both at $50, this is how the call option would look like. Right, and then you will have the put option, which is again at the same strike price. So this is how it will look like. Now time to add the two options together. That's very simple. Basically between 0 and 50 in this region, this red graph is 0 while the green graph is slanting upwards in this direction. So the slant plus 0 will give you this net slant. So let me increase the size. This is how the addition of these two options would look like. Similar thing goes here above 50 to 100 and above. This green graph is 0 while the red graph is slanting upwards, so slant plus 0 will give me the same slant. So this is how the particular net payoff function for long straddle option trading would look like. Now this particular blue graph does not include the price that we have paid for this particular option. If you remember, we have paid $5 for long call, $5 for long put, so total is $10. And what we need to do is, since this is a net outflow from our pocket, this $10 needs to be adjusted for, and since this is a net outflow, we need to shift this graph downwards by that amount. So what will happen is, this blue graph will, whatever is at 50 would come down to 40, whatever is at 40 would come down to 30, whatever is at 0 would come down to -10, and so on. So this is how it would look. This starts at 40 and ends at 0. This one will start at 40 and end at -10. Similarly, on this side, this is how it would look. So this is the net payoff function for a long straddle option trading strategy. And if you look closely, these are the two break-even points. One is at 40, other one is at 60. By break-even points, it means that these are the boundary conditions which determine the profit and loss regions. If the underlying stock price remains above $60, we are going to make profit, and that is what is indicated like this. As the stock price will keep moving upwards, my profit will keep on increasing. However, and the same is true on this side as well. As soon as the stock price will go down below 40, my profit will start to increase linearly. The lower it goes, the more profits I'm going to make on this particular trading strategy. However, this was only about the profit area, where the profit areas are like one in this direction and the other one is in this direction. So I have two profit areas. What about the loss area? Let's look at the loss area. Loss area here is in this region between these two break-even points. So between 40 and 60, anything that where the underlying stock price comes up would result in a loss to me. The loss is maximum at 50 because this is where the maximum loss of $10 will occur. So the loss would, as soon as the underlying price will keep moving further and further away, my loss would eventually cross the break-even point and become profitable. Same thing goes on the lower side as well. One more thing to note is that this might cost you a big amount of money because you're buying two options, as well as you'll have to pay 4 times brokerage fees, because you'll have 2 trades at the entry and 2 at the end, but no margin money is needed here.